Good day to you, and welcome to Fascinating. I'm your host, Rick, from planet Vulcan. My ongoing mission on planet Earth to search for signs of intelligence and to encourage its spread. In a fascinating podcast during Season 1, I offered some tips to help young listeners and other inquisitive people along on their quest to achieve higher quality thinking. Things like understanding the difference between a generalization and a theorem, understanding the advantages of a trade-off approach rather than framing things as good and bad, understanding the difference between a stock and a flow, understanding the difference between tactics and strategy, and understanding how nature allows us to choose means but not ends. Continuing in this vein, we will now examine in detail a recent event in Earth's history that illustrates a type of defective thinking that is unfortunately quite widespread among humans, namely the idea that finding someone to blame when something goes wrong is tantamount to diagnosing what went wrong. My hope is that you will learn to recognize this tactic and see it for what it is. There is no sphere of human activity in which you do not observe this sleight of hand being used. I use the term sleight of hand advisedly because it is clear that many of you do, in fact, understand this tactic for what it is and cynically use it as a method of diverting attention because it works. Fascinating. In this essay, senior contributing editor Prego Donata trains his spyglass on the worldwide financial crisis of 2008 as an illustration of how the blaming tactic works. If you will recall, the commonly accepted explanation for the crisis was and is that the root cause of the crisis was greedy bankers. Prego writes, first, some background. In 1984, the Continental Illinois Bank failed due to a combination of sloppy management, bad luck, and outright fraud. Federal banking regulators stepped in and, employing for the first time the doctrine of too big to fail, kept the bank on life support and paid off not only those whose deposits were guaranteed, but also paid off creditors who would have lost their investments but for this intervention. 7 years later, they pulled the plug, and the failure of the bank became official. The too big to fail doctrine states that the failure of a big financial institution could create ripple effects throughout the financial system that could be very damaging, if not catastrophic. This belief and the accompanying belief that regulatory intervention can eliminate the risk still dominates, even though it's difficult to imagine a worse catastrophe than the one that occurred anyway under this regulatory regime. Those who were predisposed to believe in regulation on general principles seized upon the too big to fail doctrine with great enthusiasm, recognizing that it supported their desire for extending and expanding their authority. Too big to fail has been a fixture on the financial regulatory scene ever since. A small but largely ignored minority of observers immediately voiced concerns at the beginning about the wisdom of assuring the managers of financial institutions that regulators would not allow them to fail, recognizing that putting anyone into a position of heads I win, tails the taxpayer loses would incentivize risk-taking beyond the range of what a prudent manager would do if failure were still a prospect. Regulators and their supporters pooh-poohed these concerns, assuring everyone that they were up to the task of keeping the financial system safe by means of strict control over the behavior of financial market participants. Then came the crisis of 2008, and it suddenly came to light that, surprise, surprise, financial market participants had been making risky investments on a massive scale, and that these investments had tanked. Financial markets froze as trust evaporated, and nobody wanted to offer credit without a reasonable expectation of getting their money back. As a substitute for trust, the Federal Reserve flooded the markets with sufficient liquidity so that funds would continue to flow. This colossal regulatory failure was spun by politicians and a sycophantic press as a market failure. And the success of the spin was due to being able to attach blame to people in the banking industry for being greedy. Very few people saw a need to look any deeper than that for an explanation. Not only were regulators able to avoid accountability for the mess they had created, but by employing the tactic of assigning blame, they also used the crisis as an excuse to expand their regulatory authority. Never let a good crisis go to waste, as the saying goes, even when it was you who created the crisis. Once again, we have witnessed the pernicious effects of the poor understanding of the principles of emergent order and self-regulation amongst members of the voting public in the U.S. and amongst their elected representatives. An indispensable element of market discipline is the prospect of failure. Putting the too-big-to-fail doctrine into action short-circuited this natural discipline, as was immediately evident to those who understood how emergent order or self-regulation works. Politicians and the press went so far as to portray the concept of self-regulation, which actually means the regulation of market participants by market forces, as regulation by market participants of themselves, like putting the fox to guard the henhouse. It's impossible to say whether those who promoted and continue to promote this idea are stupid or whether they just think we are. Newsflash, nothing has been resolved. The too-big-to-fail policy is still in place. Regulators are still telling us that there's no reason to worry because they are being tough on bankers and are working hard to bring other institutions that might be large enough to create systemic risk under their authority. We need to understand that even if one believes that regulation of the behavior of bankers can be effective, regulation never occurs without both direct and indirect costs. For example, do we really want such a tight cocoon of requirements and prohibitions in place that those being regulated have no room left to maneuver? I believe that regulators getting tough has been and will continue to be both ineffective and damaging, and it's only a matter of time before bankers abruptly and inexplicably become greedy again. I see a parallel between the behavior of the bankers and the behavior of Physarum, an organism I described in a fascinating podcast essay in Season 1. Also known as slime mold, Physarum is an agglomeration of single-celled organisms. It lacks even a rudimentary nervous system, and it has no muscles. It is able to move by contracting its outer membrane, which squishes the cytoplasm in the direction that it somehow knows to be the right direction. It forages and does other marvelous things in a seemingly intelligent manner. Scientists have been conducting experiments to study and try to explain the behavior of slime mold. Many of these experiments have involved sprinkling oat flakes around a concentration of Physarum and observing foraging behavior. The slime mold inevitably finds the oat flakes and does so efficiently. Think of bankers as the cells in the superorganism called the financial market. Bankers collectively respond to incentives, including the incentives regulators put in place, intentional or not, and this response results in an analog of Physarum's foraging behavior as it goes after the free goodies. I predict bankers will eventually find more paths to the free goodies we have created with the too-big-to-fail policy, just like slime mold finds the oat flakes. If you sprinkle the oat flakes around, don't be surprised when the slime mold finds it. And don't be surprised when the regulators who laid out the oat flakes try to blame the slime molds. Don't get me wrong, I am not by any means arguing that systemic risk is a mere figment of the imagination. What I am arguing is that of all the possible sources of systemic risk, regulatory intervention is the one we should be most concerned about. This crisis was not the first crisis that was made worse by regulators. A strong case has been made, for example, that the Great Depression of the 1930s was made far lengthier and far more severe than it would have been by the actions and inactions of those running the regulatory apparatus at that time, the Federal Reserve System. By way of background, this current incarnation of a national bank was created in response to the Panic of 1907. Panic is what they used to call what are now called cyclical downturns. During the cyclical downturn of 1907, many banks failed due to bank runs. Some of the banks failed because they were truly insolvent, that is, their assets were less than their liabilities. Other banks that were solvent also failed simply because their assets were not liquid enough to satisfy the withdrawals their customers were making. So the Fed was set up with a mandate of being a lender of last resort and a mission to make loans to banks that were solvent but illiquid. But when the panic that began in 1929 led to loss of confidence and runs on the banks, the Fed decided not to make the loans for reasons they thought were good at the time. In addition to this failure to act, the managers of the Fed made a number of incorrect diagnoses and perverse prescriptions, such as raising interest rates and shrinking the money supply, because they believed that they needed, first and foremost, to act to stamp out speculation. The actual effect of their actions, as opposed to the intended effect, was to accelerate the rate of decline of economic activity and to do profound damage to the evolved and evolving ways of doing business that supported the continued function of the complex dynamical system within which people lived and had their being. Thanks to Prego for this essay. Prego is being modest, by the way. He neglected to mention that he predicted massive regulatory failure as the eventual outcome of the too-big-to-fail policy back in 1984, when the first of many bailouts was done. Earthlings are a fascinating species, and it's surprising to us how well things actually function on your planet in spite of the things that go on. I invite you to have a look at the next video coming soon on the fascinating YouTube channel. Please provide feedback if you were so inclined. You may contact me by sending an email to Senior Contributing Editor Prego Denata, pregodenata@gmail.com. Please recommend the fascinating channel to your friends and give it a like if you find the lessons from nature in these essays personally valuable. Thanks to Track Tribe for allowing the use of their song, Helium. Live long and prosper. Savor your experiences, treasure your memories, and anticipate the future with happiness. And respect nature's wisdom.